Thank you. I hear a lot of amazing things you've been doing with your money, which is great. So very quickly before we start, quick disclaimer, the views are like personal views, they're not the company views of the panelists. This is not financial advice, you can always consult your financial advisor. And here we're talking about investing, so make sure you've repaid your expensive debt, you have some savings on the side, and if you're investing, it's for the long term, so we're talking like 10 years plus. So welcome to our amazing panelists today. We have Julia Groves, we have Liv Sibony, and we have Georgia Stewart. So very briefly, Julia, you co-founded the Crowdfunding UK Association in 2012, and you're now in charge of Downing Crowd, so helping retail investors to invest in bonds. And this is all in impact investing space, obviously. Liv, you're the head of impact investing at SeedTribe, and you're also an entrepreneur. You had your other businesses before, and we're going to talk about that. And Georgia, you are the co-founder of a new app that's coming out that's called Tumelo, and that helps all of us invest in the stock market, in impact investing funds, basically. So we'll start with you, Julia. I love your background, so I didn't want to read your bio because it was too long and it was too complicated. You're not old, but you've done so much in the space, especially in crowdfunding. But I love that in 2002 you actually launched the BritishAirways.com website.
Yeah, no,
Can you?
1994.
Wow. Can you?
Who was born in 1994?
Yeah, no, all of us.
Like so aged, you need to use the
Can you take?
horrendous. I know the idea that I need a microphone. Yeah.
You know, it's just for the camera. So can you tell us your story and how did you end up working in the space?
Okay,
in like 2-3 minutes.
Yeah, right. Okay, so I grew up in British Airways and I started the website because I was in advertising and there was always some silver-haired man who had already done what I wanted to do. And I was very much enjoying Marlboro Lights at lunchtime with the Chablis. That's what we did. The advertising agents used to bring cigarettes into the meeting on a little plate. And I loved hanging out with Morris Saatchi and carrying portfolios around. I thought I was it. But it became very boring because I couldn't change anything and it was all the same as it was before. So the internet came along and for me the real excitement was that it rebalanced the power between individuals and organizations. So when I grew up in the 70s, there was like 3 TV channels, one carried adverts, and when it said Persil washes whiter, we all went, oh, Persil washes whiter. We'll buy Persil, it washes whiter. And we were genuinely convinced by advertising back in the day. And so it really felt that there was an imbalance of power between these great big companies who had a lot of money and a lot of media and all these individuals who sat behind their TV screens. So Web 1.0 for me was about more transparency and individuals, cutting through intermediaries and dealing with companies in a different way. Web 2.0 for me was then when we started talking to each other, and this was where the fascination with crowdfunding came along, because suddenly if it's not each of us acting as individuals against or with a big company or a government, but we all club together in like a Groupon type fashion, it fundamentally changes the balance of power. So it's far too long to get into, but I've done 8 startups, mostly in the environmental space, sort of beautiful wind turbines and free solar panels, and I guess I got to the point where I concluded that if I wanted to leave the world in a better state and make things more sustainable, I had to change money. I don't really like money. I've got some, which is great and very helpful, but I'm fascinated by what money can do and confused by a financial services industry which thinks that money is the end objective as opposed to the means to the end. So I was running a platform called Trillion Fund, which did triple bottom line returns, people, planet and profit, and was told by the Financial Conduct Authority that what we were doing wasn't technically sort of legal. But what was, I just had this, there's so many rules.
That must have been like super stressful.
Well, Yeah, I do stress. No? But I think the key thing was that so much of financial services was only open to people who already had a lot of money. So what is the point if you've already got a lot of money? Like if you have £20,000, you can invest in this. If you don't have £20,000, you can't. I mean, that just sends the hairs on the back of my neck up, you know. So we ran a campaign called "Wealth is not a skill set." Just because I'm poor doesn't make me thick. Just because I'm rich doesn't make me clever. And we managed to change the regulations such that anybody could invest directly into businesses. And I'll come on to, I think, transparency. But anyway, so crowdfunding is a key part of my theory of change, because I think that we talk about, you know, what's the definition of impact investing? Yep. All money has an impact, whether you like it or not. And all I want to help ensure happens is that your money has the impact that you want it to have. Frankly, if you want to fund child trafficking and drugs and arms, that's groovy. Go for it. I'm not trying to teach people any morals. I'm just trying to say that your money is part of your identity and your values, and it either is or it isn't doing what you want to do with your life. There's no escaping it. It's either a problem or it's a solution. Sorry, you can't just sit there anymore.
Thank you. So we'll talk about the different ways you can invest in impact. So here we're talking about crowdfunding, but we'll also talk about the stock markets. We can also talk about angel investing. So I mean, there's a lot of different things. And Liv, actually, we talked a lot about this because you came to our workshops on investing, and you on the other side. So you're an entrepreneur, and now you're working in the crowdfunding space for impact, and you run this beautiful business that's called SeedTribe. So can you tell us a little bit about your journey and what you do today?
Yeah, so I have a slightly meandering background, having worked in charities, public sector, third sector, the food industry, Goldman Sachs, and then I started up my own startup. So I ran it for 5 years. It was called Grub Club. It was a food tech platform. And my purpose for setting up Grub Club was really I wanted to use food as a vehicle to change the world and enable people to make, or empower people to make more ethical decisions about their food purchases. And I thought by starting with creating sort of social dining experiences and getting people around the table and speaking to the chef, and the chef talking about where the food comes from, was a sort of way to kind of bring to life the story of food and your experience of it, and hopefully change people's mindsets. What I think I did terribly wrong is that that was my vision, but I didn't really embed the purpose of my mission into the business model of what I was doing. So our business model was really about selling tickets, and that's how we made money. And actually what I learned through that is the more we had to raise more finance from investors and show our growth in order to hit the metrics we said we would to get to the next inflection point, the more I just had to focus on the numbers, and all of the rest just had to go, basically. I would try and do it on the side, but it's really hard. And it got to the point after 5 years that I sort of fell out of love with what I was doing, because I was working extremely hard, which is totally fine by me, but it wasn't getting me to the purpose of what I wanted to do. And I think the minute, for me, I start losing that passion about where I'm going, everything just slightly falls apart. So I learned a lot, amazing experience, and I'm extremely grateful for 5 years of experience of doing that. But it came to the point where I felt I wasn't the best person to help the business grow in its trajectory. So we sold it to our US counterpart. It still exists, it's still going. And then I basically sort of thought, okay, well, there's so much I learned from the traumas of being an HR manager at Goldman Sachs for 7 years, including 2008, and of running and scaling my own startup, that maybe I can sit on the other side of the table and see whether there's anything I can do to try and change the system. So that's when I came into SeedTribe, which is a spin-off of the Angel Investment Network, and I essentially try and find investment for impactful startups.
Thank you very much. And Georgia, so we met at the NatWest FinTech Accelerator, so we are both trying to grow our startups. And you've built this amazing business that's called Tumelo. So can you tell us where you come from, because that makes a lot of sense actually, and I love that you have your background and now you go into investing and trying to put them both together.
Okay, yes. So I went to Cambridge and I did natural sciences, and I thought I wanted to be a vet, and then that hasn't happened 6 years later. But when I was there, I studied climate change and ecology, and I was really caring about conservation, and I really loved David Attenborough, and it all kind of came from that, basically. And when I first joined, aside from kind of doing lacrosse and other stuff that was more fun, I joined this committee at the university called Positive Investment, Cambridge, which was basically trying to move the university's endowment into more green investment. So the university's got £5 billion, which is like the largest of any higher education institution in Europe. So it's a lot of money, and at the moment it's completely opaque, and it's invested in like everything from outfits that kind of encourage gambling and porn and probably have really terrible supply chains and also environmental disasters, and they're definitely backing oil majors and that kind of thing. But the point was it was also completely untransparent, and so no one really knew where it was, and it was very hard to prove. So we set about trying to change that and set up kind of working groups with the council and did all sorts of exciting things. I went to COP21 in Paris, which is a big environmental conference, and that movement wasn't just at Cambridge, it was sweeping across America, the divestment movement, which is the idea of selling out of kind of sin stocks like coal or tar sands and oil, and it was also sweeping across the UK, so institutions that felt they had a responsibility, like charities like the WWF, or generally city councils and universities, were saying, okay, actually, we're teaching about climate change and we're telling you to recycle and we're trying to save you from smoking, but we're investing in tobacco and oil and that kind of thing. And so they started trying to right that wrong. So when we left university, me and my two co-founders, who'd been involved in this together, we were really encouraged by how excited students were about this kind of sustainable investing movement. And I think on the one hand, it was interesting because our passion was, okay, if we can move money into the right place, and to back the right companies and engage with the right companies, then that's a really sure, fast way to improve the way the world works, because you're not starting at the bottom with a plastic bottle, you're going to the top, to the directors of Unilever or P&G, and you're changing how much water they use. And these are massive companies that generally move the needle. And then on the other hand, what we noticed was that ability to talk about money through a different lens, like gender equality or environmentalism or just technology, gave people access to a conversation that they hadn't really had access to before. And people, students at least, we saw, felt like they could talk about finance through a different lens, rather than just talking about like the stock market and the percentage increase or decrease, which is dry and also feels much more inaccessible. So we wanted to build a product that combined those two things, and that's where Tumelo came from. So we built a platform that helps people with any amount of money invest into the stock market in line with a value that you care about, like gender equality or environmentalism, and then helps you engage with the companies in your portfolio. So that is kind of, I guess we'll talk about it later, but something like impact investing is really broad, and it goes from like crowdfunding all the way through to if you're making stock market investments, they don't have to be, you don't have to be blind to where your money is going, and you can kind of invest it in line with your values and then follow that through. And that follow through is also really important. So that company needs to know why you've bought a share of that company and why you've not bought a share of its competitor, for example, and you're making sure that they understand that you're effectively an activist and a kind of active investor.
Yeah, thank you very much. So we talk about value, we talk about impact. But actually, what's the definition of impact investing? We saw there's a lot of different definitions out there. For me, it's basically putting my money into something that has an impact, but what's an impact? And at the same time, making financial returns on my money. So maybe, Julia, you can give us a definition of what are the different
I'm
segments of impact?
I'm really wearing. I think it really has to be your own personal definition of impact, and I think it's quite a emotive word, depending a bit on your experience. So I think if you speak to somebody in their 50s who tried one of these impact funds 10 years ago, they'll roll their eyes, and because it was all very sexy way back when, but in many cases either it just was a lie, it wasn't really impact investing, or there certainly hadn't been enough scrutiny. They'd done like one layer of research and hadn't looked further, or they just use it as an excuse, frankly, to raise money cheaply from mugs. I mean, that is genuinely my view. They went, impact, yeah, so I'll just give you 3%, I'll pocket 3%, and off we go. Or it failed, and some of the funds really didn't do particularly well. So again, I completely agree with George's point around transparency. The challenge is you just can't see where your money is. And that applies to your debt as well as to your investments. So think about it, when you borrow money from a bank or a different area, who they give it to is also part of the equation. So you can move your debt as well as moving your investment. Your debt can be influential too. So for me, my personal, and I'll only talk about my personal definition of it, I mean, I think historically it meant that you were looking for a blend of return. It wasn't a donation. We weren't giving money away. You were expecting return of capital. We are, as a country, radically moving away from donation. I did a project for the Department for International Development on peer-to-peer solar in Africa, because they said, well, we could never possibly get the UK public to fund solar in Africa. At which point I went, you've got £12 billion, and it costs £300 to get a solar panel for a family in Africa, which means they have light for the kids to study and to charge the mobile phones so they can communicate about when the markets are on or off. Is there anybody here who won't give me £300? I'll give it back to you in 5 years with a 5% return. You can put it in your ISA. It was impossible. I'm like, my God. So we did a project with them. And what was interesting is they're moving towards this idea of sort of debt forgiveness rather than donation, because donations are less sustainable, right? You put the grant money in, the grant money runs out and it peters away. Whereas if somebody at least has got a plan for how, in theory, they could pay the money back, you create a more sustainable enterprise and have a longer legacy of what you're doing. So anyway, so it's not donation, it's not pure capitalism, I'm going to screw everybody to get the best risk-adjusted return I can. There's a degree of a blended return, but I think George is right as well, that the days of when you had to really compromise to do that are hopefully coming to an end. But try telling that to the 50-year-olds who've got the money, because they've had their fingers burnt. So for me, the most important thing is I would kind of go at least do no harm. So I'm up for the exclusion element of portfolio, and hopefully make sure that it's responsible and sustainable and reflects your values. So I'm sorry, I'm not answering the question the way you want to answer it.
No, I think
it's
clear. And
so they've got impact in their job title, and I haven't.
I know. So we hear a lot about ESG and SRI, so it's basically everything around the environment, around making a social impact. So are these like two different worlds, or it's all embedded within this like impact world?
Well, again, I think you have to break it down. They tend to go together quite easily, because most things which are environmental can be social. So I like the triple bottom line analogy. That works for me. So people, planet, and profit. So environmentally and social. It's also ESG squared now. There's all kinds. Don't worry about it, right? There's far too much jargon. When I started doing investment, I was 42, and I spent a day researching bonds, and got to the end of the day and went, oh, it's just lending money. Yeah. So annoying. So, I mean, it is massively off-putting, all the jargon, but it is really, and trust your instincts as well, because it's just basically like, where is the money going to? What are they going to do with it? What are they going to do if it goes wrong? Who's taking a little slice out of it? So yeah, environment, socially responsible investment, SRI, ESG, environmentally, socially, and then the gender bit comes in as well. Try to avoid the jargon and ask the really basic stupid questions, because there is no such thing. And if they can't answer it, run away.
Thank you. So Liv, what's your own definition of impact investing?
I do agree with Julia that it's, there isn't sort of one set definition, and I realized that when I was launching SeedTribe, and I had to define what impact meant, and I suddenly got myself in a bit of a pickle. I think To me, the way I position it with SeedTribe is that it is profit for purpose. So for me, it is about supporting profit-driven organizations whose mission is to address a social or environmental challenge. I think I'm able to have that definition because I just work in the world of startups, and so they are bringing in a new system and a new way of working, and so it's okay to sort of position it that way. When you're looking at the broader market, that doesn't really exist historically, so you would have the almost an inexistent market. So I think it really depends what level of activity you are looking at. And actually similar, also agreeing with Julia, so SeedTribe is a spin-off of Angel Investment Network. So Angel Investment Network connects entrepreneurs and startups, and it's been going for 15 years. It's got almost 200,000.
Can you just define angel investments versus crowdfunding, because I think that's helpful for...
Yeah, it's all just kind of, they're all on a scale, I guess, on a sort of spectrum. So essentially it is investing into companies, but it's investing into startups, and it's usually people sort of what we call high net worth individuals. So people, there's a couple of definitions, but essentially if you earn more than a couple of $100,000, you'd be a sophisticated investor or a high net worth individual. So you could put between 10K and 200K into a startup. That is.
Has anybody got 200K that would like to
got loads of options for you. That's really easy.
Because angel investors basically can also work together. So I know there's a few entrepreneurs in the room who have raised some, initial rounds with angels. So if you need to raise 100K, 200K, you don't need to get actually one angel investor. You can get a syndicate, so a group of angel investors, and they will each put between, I think the minimum is around 5 to 10K, because then it gets super complicated. But these guys are angel investors. So even if you don't earn maybe 200K, you could potentially also become an angel investor.
Can I do a really sorry. Can I, just because I've been sat, can I just go really, really basic, right? So there's equity and there's debt. So if you want to invest, you either lend your money to a company and you think you're going to get the money back, probably with some interest paid, or you invest by buying shares in a company. And there's two reasons for buying shares in the company. One is because you're buying shares in a company when it's quite small and doesn't make that much money, and you think it's going to grow and be massive, and then you'll sell your shares and make 10 times your money. Or you buy shares in a company that's already profitable, and they pay you something called a dividend, which is a bit like interest rate, but it tends to go up and down. So when you invest in the stock market, you buy shares in what is already quite a big company, because it's not trivial getting onto a stock market, and you sit there and get your 5, 6, 7% dividend, which depends on the performance of the company. If you invest in Liv stuff, you're going in really early, and it's much riskier. Probably about 60% of the companies completely fail, and you will lose absolutely all your money. But if you choose well, or somebody chooses well for you, one or two of them, you'll make 10 times your money. So I'll give you an example. And then there's EIS. Do you want? Yeah. So the government is really, really keen to get us investing in things, and particularly since the banking crisis, a lot of the banks are not lending their money to small companies. They genuinely aren't. I did the Oxford Union debate with the then CEO of Barclays the week before he left. Nothing to do with me in the debate. So this is how Anthony Jenkins debates. So he did a presentation, I did a presentation. He sat down and got a female head of one of his units to do the debate with me, because I'm a crowdfunder, and why would the CEO of Barclays crowd? I swear to God, I obviously won that one. And he said there's no issue, but there is an access to finance gap, because since 2008 the banks are not lending. And the frustration I've had as an entrepreneur trying to raise money in this country is it can be tricky to do. So the government has something called an enterprise investment scheme, and certain types of company can raise the £1,000 from you. They get the £1,000, and the government will give you 30% back. So you put your £1,000 in, and you get £300 back from the government straight away. So you've only actually invested £700. so much, right, of the startup market in the UK is driven by enterprise investment. So I did one in a company called Loco2, low CO2. It's a European rail booking engine trying to get people off planes onto trains. I invested £7,500, and 5 years later I sold it for £168,000. I didn't pay any tax on it. There might have been a few others that maybe didn't completely go that way overall. But it's a brother and sister operation. It's all based in the UK. So if you want to do early stage investment, this tax advantage means there's no capital gain if you do very well. And you're not exposed to the full investment risk. You get 30% of it back, and from the government too. Sorry, that was just really plonky. Oh, hi. Nice. Oh, look.
Should we give it back? Oh, we can give it, yeah. Okay, cool. Thank you. That's actually really helpful clarification. So just on the impact, but I also think it depends who you're positioning it to. So when I speak to our network of angel investors who've originally signed up onto the platform because they're looking at any kind of investment and I'm convincing them to do impact, I actually don't use the word impact at all. I talk about the financial returns and the great opportunity of the business, et cetera, and then as an afterthought, by the way, you might actually be doing good in the world, but don't worry too much about it. It might just help you, make you feel better, because actually at the end of the day, my purpose is to fund these really great startups. So I need to speak the language of the people who understand that language. When I speak to external people and I'm trying to get new investors to come on and invest into these platforms, then I big up the impact, because I believe that people should, again, as Julia was saying earlier, and Georgia as well, I think your money, you can do so much with your money, and it's a really, really strong voice. And actually, I think people should actively be able to manage their money while feeling that they're not making a sacrifice, but also having a positive impact in society. So
can you give us one or two examples of like successful campaign you've run or successful businesses that got funded?
Yeah, so actually it's interesting. So I was just saying to Julia, I should have said to you as well just before starting, I'm sort of partly now straddling both crowdfunding and normal angel investing in terms of finding investment for the business. Julia warned me when I launched my platform last year that crowdfunding is really niche, but I had to kind of live through it to realize that. Should have listened. But essentially crowdfunding is wonderful for very consumer-facing companies that is easy for a lot of people to understand. But there are a lot of really amazing, impactful companies that are B2B and not so easy for people to understand and actually can have a really, really great impact, but it's just not quite so straightforward to get the public to invest in. So with regards, in terms of the companies that I've I've successfully found investment for, I think there's a couple of them that I think are really exciting. One of them, okay, they're not exciting. I get excited about them. One of them is a plastic recycling plant, which to me is exciting. And it takes plastic and it turns it into food-grade pellets so that we can then reuse it into other materials. And it's just, I find it really fascinating because actually you get, as a business model, you get paid to get the supply because you're taking away the plastic from the landfill, and then you get paid for the output of it as well. And in the foreseeable future, there's a lot of plastic available. And because this is PET plastic, the plastic that's made out of your bottles, it's also the one that is the least likely to leave our system in the near future because it's incredibly practical. It's just that the point of plastic is that it's kind of indestructible. So let's actually make use of that incredible magic of what plastic does offer and reuse it.
Now the good jargon buster, isn't it? Circular economy.
Yes.
Has anybody heard of
yes.
the circular economy thing? Does that what makes sense?
There's a few businesses actually.
Yeah.
The circular
Yeah,
economy.
circular economy is
Does anybody not
magic.
know what circular economy is? Yeah.
Yeah, okay, so circular economy is essentially usually termed around sort of environmental businesses which use surplus as their raw material in order to, reuse it as another product. So like plastic recycling, or you could say, for example, there's a really cool company called BioBean, and what they do is they take all of the coffee waste from could be the coffee shops, but it's actually mainly the big coffee producing factories, and then they take that, they turn it into biofuel, and that's what powers most of the London buses, for example. So it's that literally circle, rather than taking new resources out of the environment, throwing them away, and then having to...
Yeah. There's Loopster, for example, is a great company. So Jane, she buys kids' clothes and she resells them on our platform. So that's another really good example. Loopster.co.uk.
Awesome. It's really exciting. I mean, the fashion industry really needs to be disrupted really badly, so thank you for doing that. Yeah. Yeah, don't buy cotton, people. Even if it's organic, it's not good.
Okay.
Don't be fooled by organic.
Okay, cool. So can we move on the stock market now? Because maybe that's I thought that would be the easiest place to start, because maybe people already have investments, and I know I already have investments. I have ETFs, I have some funds, and I realize all my money is into these like massive companies making a lot of money, so hopefully I'll make some money, but now I don't really feel good about it. So how can I sort of change my investment portfolio? What are my options in terms of maybe shares, bonds, funds, and how do you define at Tumelo what is impact investing?
So I think traditionally, like you guys were saying, impact investing means you're making a measurable impact. So it's that idea of like you're investing in something and there is specific change that can be more or less related back to the money you put in the first place. So we as a company, Tumelo, or investing in the stock market, I would say doesn't really fit into the traditional definition of impact investing, 10 years ago or maybe 20 years ago. And we don't call ourselves that. So as a company, that's not what we call ourselves, because I think it confuses at least who we're targeting at the moment, which is investors in general, like people to fund our company who understand the differences. So then within the stock market, there's lots of different terms like sustainable investing or green investing or SRI, which is socially responsible investing, or ESG investing, which is environmental social governance investing, and they all basically mean the same thing. And it's not, that definition doesn't really define what you're going to find within the fund. So I did a bit of work at Jupiter Asset Management. They've got a responsible income fund. The fund is very similar to if you go to Lion Trust, who have a sustainable futures fund. It's just like products in a supermarket. They're just calling them different things to make them stand out.
And just a quick step back is when we talk about the stock market is for businesses who want to raise actually a lot of money. Sometimes they can't do it privately, so they have to go public. So they have to either list their business and then sell their shares. So you as a retail investor, you can buy some shares in the company and you become a shareholder. And we talked about debt, so companies can also raise some debt, and they can also do that through the market. So it's not the stock market, but it's still the market, and this is through bonds. And that's what we invest in when we talk about the stock market.
And one of the challenges, I guess, is as soon as you are public, you have a lot of scrutiny. There's a lot of reporting standards which you would like, but one of the challenges is this constant expectation of the market of growth, quarter on quarter. And I think it can be a challenge for companies to make longer term decisions and investments because the expectation is it's going to happen. So you do get some companies choosing not to go public even though they're big. But yeah, I mean, I find it very, very difficult to navigate that. When are you going live? I'm in your queue.
So, yeah. So, I mean, we will be, yeah, I know. Yeah, okay. We'll be live next month, so you can sign up to the waiting list. Please do that. That'd be really good to have some beta testers. But I think one of the points that we were talking about earlier is around risk. And that is an interesting topic, because if you're talking about, you've got, I don't know, say you had £10,000 in your savings, or even £5,000 or £1,000, doesn't matter how much money you have. You want to make sure that you're investing in line with your own risk profile. So it depends how long you're investing for and what other things you have going on in your life, if you have children, or if you're trying to save for something in particular, or if you're trying to buy a house, or if you just bought a house. And so investing in startups, like we were talking about, is quite high risk. So it's not necessarily the solution to, like, I'm a startup and everyone should invest in me. So it is a solution. No, it wasn't. But it's one part of the solution. And I think when it comes to impact or sustainability, these alternative investments, so investment into private equity or kind of crowdfunding or startups, it's quite illiquid. So when you put your money in, it's quite hard to get it back. And there are great platforms that do it. You know, Abundance is another one which I love, and I have an account there. But you're investing for kind of 5, 10, sometimes 20 years as your money's locked away and you get a return, but you don't necessarily. And an alternative to that is investing in the stock market, which is much more mainstream. But the nice thing about it for us, and especially for the target audience that we were thinking of or inspired by when we first made the product, which was students and young professionals and you know, people that didn't necessarily have a lot of money and that also might need it back, and you know, within a week or within 2 weeks, or and might want to kind of put a little bit in over time and take a little bit out over time, and that's called liquidity. And the stock market is much better for that than investing into like one company where your money's locked away. And I think that basically both need to move towards sustainability, and that in private equity you have more opportunity to make direct impact, but ignoring the stock market entirely and being like, oh, you know, you can't make impact there because you're already investing in massive companies is silly, because you definitely can. And I think for us, where the real impact comes from is you move your money into the right companies and you exclude the wrong companies. So you add a kind of negative screen against coal and oil and that kind of thing. But then you can have a positive screen for companies that have great gender equality policies, or have really good kind of ratio of female executives, or have really good environmental policies within the company, or more importantly, are producing really good environmental products like externally, and that it's both looking internally at the company and what they're doing to the world. So that's one thing I think where in the past it's been missed. Like British American Tobacco, for example, is like at the top of the MSCI social index because they've got really good like workers' rights. But then everyone's just ignoring the fact that they produce tobacco. So it's crazy and it feels really hypocritical, but I think that's where it's got such a bad name in the industry, is these kind of, you have to really be careful about what you're investing in, and that's quite hard to do, which is why we're producing a platform that helps you do that, because at the moment you have to look at all the underlying securities inside each fund, and it's really complicated.
Yeah. And just when we talk about a fund or an index fund, this is basically a pool of money. So all of you and maybe like tens of thousands of investors will put money. There's going to be, so it's either active or passive. So if it's active, you have a fund manager, so someone that's going to decide, okay, what am I going to buy? What am I going to put in this fund? So he's going to choose the investments, the different stocks, the different companies, and then you can buy a unit in the fund. But active is very expensive because you have to pay this fund manager that work really hard, and their goal is to outperform the market, to do better than the market. But actually, research has been showing that it doesn't really work. So you should rather maybe go for a passive, and you have all these big US investors such as Warren Buffett who have this like massive quote saying, you know, passive is better, passive is better. If I die tomorrow, my wife should just go put all of her money into passive. And passive investing is basically done by computer. It's an algorithm, and it just follows the performance of the market. So very basic, you want to follow maybe the FTSE 100 or you know the S&P or like one of the market, then the index will just mimic the performance of this market and buy all the companies that are existing. So you don't have yourself to go and buy like into 500 different companies. You just buy one unit in the fund and you're exposed of the overall performance of the market. So fund is actually a great way to get started. And I guess with Tumelo, you're gonna propose funds.
Yeah, so they're passive funds, and instead of following the entire market, like instead of following the FTSE 500, you follow companies that are like positive. So you're excluding the ones that you don't like, that don't meet the criteria, and you're including ones that are kind of contributing to positive change. But I think the one thing, what we call it is positive investing, and I think that's just because that's what I called it at university. We don't call it impact investing, and we really try to steer clear of the word sustainability because it's very subjective, and what's sustainable to you because you really care about gender equality is not sustainable to me because I really care about climate change, and it's just so subjective that it's a really difficult word, and ethical is kind of the same, like what ethics basically means morals, and that's kind of completely up to you, right? So we try and call it thematic, and we really technology for this fund, and you have to choose what you care about. And if you invest across different funds, sometimes there's contradictions within that. But what is really important for us is engagement. And I comes to the stock market is where you have an ability to make a difference is because you are investing, whether passively or actively, but as a shareholder, you have an ability to affect the reputation of the company that you're investing in. So as Tumelo, what we're doing is we're partnering with NGOs. So like Share Action is a really interesting NGO that's worth looking up in London. And they partner with big institutions like the NHS and like university endowments and big fund managers to pressure companies for positive change, like in workers' rights or in environmental change or in gender equality. And we're partnering with them to allow our retail investors to have a voice at that table. And we can do fun things like nominate people to go to AGMs. So literally you can like be in a room with Unilever directors and be asking them questions about what the hell they're doing in terms of plastics, or we can celebrate the fact that they might be quite good on some things like gender equality, but really pushing them to improve. And the idea for us is, like you guys were talking about before, about being lots of people together, being bigger than one person, is at the moment as a retail investor, even if you've got £10,000 or 20,000 or 100,000 pounds in a company, it's meaningless because on your own it's not enough to make a difference. Whereas when you're a collective group, you have a lot more money, and if you kind of have a lot more voices together, then you can pressure the companies to make change. And that's why I guess we're calling it kind of positive or activist investing, where it's rather than just investing and forgetting about it and being like, okay, yeah, I did a good thing. It's okay, well, I did it, now I'm going to follow through and I'm going to make sure that it is doing what it says on the tin.
Okay. Great. So I just wanted to finish with asking you, what do you think is the risk return? So can you really make money from impact investing? And I think research is showing that yes, you could. And if you need to get started tomorrow, practically, how could you do it? Like, is there an ISA? Is there a specific structure that you could get started with?
So I'm very keen on the action bit of it. So I'm now going to make a financial promotion. Yeah, I am. It can all sound really complicated, right? You can come to this and then you can go off to work and not get round to it. And it's just so easy to do, isn't it? So don't be daunted. Do look at moving your money. I think what Olivia and I are particularly keen on is the ability to start with a small amount of money. So take a small amount of money that you could actually lose. And I start with £100. And try things and do things and learn and get experience and get through that, if you've got it, that mind block of it's all too scary and difficult and I'm worried about doing the wrong thing and I don't know if that happens. So I do very simple bonds. You put £100 in and 2 years later you get your £100 back plus the interest. And we do renewable energy, and we also do care homes. It's not all impact by any means. So I am going to give Vestpod a code for 0.5%, and I will give any of you an extra 0.5% interest rate if you pick and invest in a bond in the next 3 months. You can also do it in an ISA, so your returns are tax-free, which makes sense as well. It's £100, and it will allow you just to start the process. It's all in a very simple offer document. I would love any feedback about what's good or bad, but Downing Crowd is trying to increase the number of people investing, not just the amount of money that's invested into renewables and other do no harm things, not all good things from that point of view. So just get off your backsides and get started. And if it's sitting in the bank, you are losing money. Inflation is at 3% when interest rates are at 0.5. Your money is literally withering away as you sit here. And if you could see what the banks are doing with that money, you would not like it. So move it.
Thank you for that. Couldn't agree more. And so, yes, investing in startups is probably the highest risk thing you could do. It's definitely not the first place you want to be putting your money. It is very much that sort of, you know, after you're confident with having put your money in safer places, then I guess the last thing you would come to is startups. And as Emily was saying at the beginning, it's really about sort of, you know, Julie was saying, you could either make, 10, 100 times your return, or you probably would lose your money. So I guess so it is super, super high risk. It really is, if you have enough money that you want to gamble, essentially. But within that, I would say that what's important is to choose think carefully. Think about an industry that you already know about, maybe something that you actually care about, and actually then you're also slightly changing your attitude towards why you're doing it. So it's not just purely because you want to make a return, it's actually because you might want to be able to influence change at the sort of grassroots level. So say you're investing in a company that it's an app that enables you to make more ethical purchases on the high street, then actually you might feel strongly that actually you'll be able to sort of make that change directly as well. So, and you know, maybe you know about sort of building apps or about I don't know, ethical marketing or something like that, or supply chains, and actually you might be able to support that company in growing and being able to be part of that change. So it's sort of looking at it with sort of your knowledge and passion and desire to change things, in addition to taking a risk on either potentially losing your money or multiplying it by a lot.
How much could you start with?
It's £100.
I can beat that. No, so both really cool, and I think there's maybe looking at doing both, like having some private investments in like renewables, which this is what I have. So I have an stocks and shares ISA, and then I also have an account with Abundance, who allow you to invest in renewable infrastructure. But so if you wanted to look at investing in the stock market and through an ISA, like stocks and shares ISA, something that's quite flexible, then you can do that really easily, for example, with our app, Tumelo, which is coming out next month. And basically, you can download it. You can start investing from £1. So there's effectively no minimum. So you could just put £5 in and play with it like a virtual portfolio if you wanted to learn for 6 months first before you actually kind of put in a substantial amount of money, or you could build it up really slowly over time. So how it works is you basically tell us what you care about, like gender equality or environmentalism or technology. We also screen your finances, so you can tell us about your financial circumstances and your attitude to risk. So whether you are in like a really chill place in life and you want to take lots of risk, or whether actually you're saving for really important stuff, so you just want to take it easy and go slow. So we then assign a risk to you, and once you're happy with that, we combine like your interests and your financial profile to create a portfolio for you. And you're invested across about 100 companies, both in bonds and equities. And depending on your risk level, we then will vary the amount of cash that's in your portfolio to make sure that you are able to kind of take your money in and out easily, and that you're at the appropriate risk level for yourself. And you can start from £1, and then you can get involved in digital activism and all that kind of stuff without having to put in like massive amounts of money. So it's maybe a good place to start if you want to learn as well, and kind of keep an eye on what's happening in the stock market, rather than kind of taking a massive bet from the offset.
So we'll open to Q&A, but just wanted to finish with one thing. So for me, the most important is, if you feel you're not ready, maybe just open a very small account somewhere, maybe £100, maybe £50, and get some skin in the game, get started with investing, and you'll really understand how it works. I mean, I've lost some money in the stock market just by buying single stocks. I mean, it was fun, but I actually lost money, and I learned from that because I've read about diversification everywhere, but I couldn't really understand it until I had my own money invested in the stock market or in startups and stuff like that. So get started. The other one is diversification. So don't put all your money into one company. I mean, I think for crowdfunding, if you want to be successful, you maybe have to put your money over, 5, 10, maybe 20 different businesses. So maybe put smaller amounts and look at different businesses. And this is the same for the stock market. So funds are a good place to start. Don't start like stock picking different companies. It's going to be really hard for you to make money. And the last one is about fees, and we didn't talk about fees, but it's really important when you start investing. It's not free, and so you usually have to pay for the platforms. You have to pay to buy your investment. You have to pay sometimes to sell your investment, and there's then taxes on top of it. So just make sure you understand what you're doing, and it's not just about the price of the security itself or the price of the investment.
The common mistake, I always go, 1%, right, doesn't matter. I'm thinking about 1% of the amount of money I'm investing. That doesn't sound expensive. But actually, my return is 5%. It's 1% of the 5%. So, that's, you got to look at it in the context of your return. It's not a percentage of your capital, it's a percentage of your return, really. And they are shocking. Some of them are absolutely shocking. There's situations where the companies make more money than the investors.
Really good point. Do we have any questions, please?
I really enjoyed the panel. I wonder if we could talk about the gender angle. So obviously it's a women's event. Why do you think it's important for women to learn to invest? How are women different in this area than men?
The year before I joined Dining, I pitched for money 52 times, and I like pitching. I sort of can be quite good at it sometimes. Yeah, but what's really intriguing is women pitching to men, and unfortunately the rarity of men pitching to women. So I got some very good advice from an American female investor at, what's the name of that old girl, begins with an A, Delphi, can't remember, all-female investing group. And she said, the problem is you are the fifth person pitching the other four guys, and the guys are saying, the guys are coming up with massive numbers, and they're kind of punching the air with a degree of certainty. And I say, we, and I come up with a smaller number that I know I'm going to beat, right? Because I don't like to overpromise and underdeliver. And I'm giving a balanced view because I think it's more credible. So when I pitch to guys, they're going, she says $1 billion, he says $1 trillion, we're going with him. You know what I mean? And he's the one, and it's going to all happen. So I was losing it all the time. And now I'm on the other side of the fence, and the pitches are coming to me. And the guys are going, I'm going to do this, and it's going to be massive, and we're going to do it in 6 months. And I'm just like, yeah, whatever. Really? You're going to do this by yourself? And I go, one man, no team, forget it. Like, he's got to go under a bus. It's just so intriguing, the difference between the two. So it's really important that we change. I was telling some of the girls earlier the story about a pelvic floor operator pitch we had at Downing, and an entirely male investment team, and them trying to assess whether this pelvic floor thing would work. And it was only the point where I said, I can't put that up my fanny because it's going to interfere with my merino coil, that eventually the investment committee collapsed. And I'm like, boys, please. You've no idea. So the key, they've got a challenge on both fronts in terms of the women investing. We need more women investing, and we need more women making investment decisions just because of groupthink. We're just different, and I think it's unacceptable to have all male investment committees making decisions.
Yeah. I just want to add to that on the stock market. So research is showing that women are actually good investors and tend to generate higher returns than men. I mean, it's slightly higher. Women invest less, but also we tend to trade less often in the stock market. So we pay less fees, and that's why we're here for the long term. So women are good investors, but we may be not as confident as men to just get started, because we want it to be maybe 100% perfect, and men would tend to just get started, make mistakes, try again, and lose some money, and we would be like, okay, what's our guarantee, what's the risk, and be ready. But it's interesting, so Bonnie, who is here, is raising a round of angel for a business, and she's raising only from female angels. So maybe Bonnie, you want to tell us about it, because it's super cool.
It's fine. I had meetings for about 2 years with men. I run a dance fitness company. I was speaking to someone yesterday, and she said, "Oh, is it for girls and gays?" I was like, "Yes, it is." My customer base is 99% women. I'm a woman. My background was dance, and I was having these meetings with these suits, and I was trying to. No. I was like that. And I tried to change myself to try and be accepted by them. And I was like, I promise I'm a businesswoman. I run a business. I'm a woman. I'm a businesswoman. And it didn't go well. And I just thought, you know what? Fuck this. I'm going to raise money from women. I had the idea to do it. I was told not to do it. I was told it was going to hold my business back. It was a terrible idea. And my team were like, no, you're doing it. So we posted it on Instagram in December, and we hit our target in 2 weeks. So I think women do invest, and I think it's definitely a myth that they don't. And I think women want to invest in what they believe in. So I think, and I'm sure you ladies do, so I think don't let the male business world or investment world put you off, and never underestimate a woman, I think.
Thank you. We've talked a lot about the stock market and how shareholders can make a difference, but also about avoiding companies like oil majors, which are polluting the planet. But do you think actually what we need is a change in thinking of not avoiding these companies, but staying with them and using our position as shareholders to change things? Because if it's the Royal Dutch Shells of the world that are causing problems for our climate, actually what we need to do is apply pressure to banks, asset managers, to change their behavior and vote against their pay, for example. What would be your thoughts on that? Actually avoiding them, you lose your voice.
Yeah, so that is, yes, so I agree with you, and that's why at university we're focusing on positive investment as opposed to a divestment campaign, and they're quite different things, where divestment, you're taking your money out of those companies, but because we're talking about stock market, specifically for that reason, if you are leaving Royal Dutch Shell, for example, the only way you can leave that company is by selling your shares to someone else, which means someone else who cares less than you has then bought those shares. So that's the issue with divestment, in that it can be very powerful if you use reputation. So if Cambridge University or King's College London or whatever says we're divesting from Royal Dutch Shell for this reason, then it can cause a little bit more of a ruffle because everyone else knows and the newspapers write about it, and it's a bit embarrassing for that company, and it might spur them on to make some change. But in general, unless you have massive reputational like Wally, then it doesn't, you're right, like it doesn't really, it's much better to be engaged. So that's why we are focusing on engagement in the platform, so you're not just investing in stuff you care about and forgetting about it. Like, I don't actually believe that makes a change. I think it's good for us to stand by our values and be invested in companies that align with our values, but moving £10,000 in the stock market to one company or another as an individual doesn't make a difference. So you do need to add that engagement level to it. I think there's a little bit of an issue for us, and this is something that I've had to come to terms with over the last year, which is that explaining that to people is extremely difficult. And for us, we need, 40,000 people for our platform to break even. So we're talking about big numbers, and we don't need them tomorrow, but within the next 3 years, like that needs to happen. And trying to explain to them, you're investing in the stock market, and it's in line with your values, but also we're going to give your money to Shell so that you can engage as a shareholder. It's just not something you can get through a Twitter advert. So there's some level of negative screening that we had to apply, otherwise we were just going to get pushback from people that quite rightly didn't understand. And also I wouldn't, if I hadn't taken this path, I'd also be an environmentalist and not understand that could be useful. There's different camps, and I think, I guess you just have to arrive on a happy medium, and that's what we're doing. We invest in big companies that are not all good. If I think Unilever will be in our gender equality portfolio, and there are parts of that company that are awful. And our ethos is we're just going to make sure we engage with them and have people understanding what's really bad about them and what's good about them, and getting people changing them. I think where the engagement becomes much more interesting is for institutions. So someone like our university endowment, or kind of London City Council, and those kind of people to be having conversations with that company, and then that makes a bit of more difference, and it might make sense for them to stay invested, but only if they're going to engage. And if you're investing in the stock market, if you guys want to go to a fund that maybe has 200 companies in it and it's a sustainable fund or a green fund, make sure that the fund manager, if you're investing in active funds, so if there's someone managing the fund for you, make sure that your fund manager is engaging. So you need to look at their voting policy. How often do they talk to the companies? What are they talking to them about? Are they voting in line with what you care about, or do they let all the votes just go straight through? Because a lot of the time you'll find that people put green on the tin, and they might invest in companies that are above average, but then there's no engagement, and that really defeats the point. Two last questions.
Hi guys, thank you. That was really interesting. I have a question about some specific companies. So I've been asking a friend to give me his advice based on some of the places he invests, and he's mentioned two companies that one was a kind of peer-to-peer lender rate setter, and I wondered what your opinions are about the kind of ethics of companies like that, and the other is BlackRock, which he said has taken a specific stand about screening across the kind of axes that you've talked about, which for me is a real advantage, because I think there is a problem with that one axis approach to investing. So opinions on those two options.
I'll do rate setter really quickly. The P2P model is super diversified. The average loan size is something like £10,000 on rate setter to consumers. Oh, peer-to-peer lending is when you lend directly to either consumers or businesses through a platform, and the platform aggregates up all the money and spreads it all out, but there's no fund in place. You're originally making your own choice. It's evolved now that they are choosing the investments for you. So my concern with rate setter is simply you now kind of go, do you want the 2.9% or the 3.8%? And it's rated A or it's rated B or it's rated C. I can't tell how they've decided whether it's A, B or C, which I don't like. And the other negative is at a £10,000 loan size, it's just done by the computer. So it's getting very bank-like. That said, they're delivering really strong returns. They're transparent. They publish the rates after bad debt. I've got some money in there. I hired their head of business development. I think P2P is fantastic. It's not transparent. You can put it in an ISA as well, yeah. So nothing necessarily against that. BlackRock, in general, I'm a fan of, but it's a big, wieldy beast. So you need to navigate it a little bit. But I think their intent is good. I can't comment on, I don't know if you know anything, I don't know. Yeah, I can't comment on results. I think the intention is good.
Yeah, I think there's a ton of funds on there that are, they've got passive funds that you can look at that are really cheap. I think one of the things that to be just wary of is when you're looking at thematic funds like that, make sure that you're not being, like your eye's not being caught by the title of the fund. So when we've been going through and selecting them, like if you're interested in investing in technology, you can invest in a technology ETF, and it's kind of like a passive tracker fund, or you can invest in a kind of drone ETF, and your drone ETF is going to cost you like 0.8%, and it's almost identical to the technology ETF, but it just has a fancy name on it. So just when you're looking at that thematic stuff, be really careful about, just don't get ripped off by the marketing.
Good morning, everyone. I'm Sanmi, and I'm Nigerian of origin, a country whose soul was damaged by oil money. So it really gladdens my heart to see that everyone here really cares about Africa and impact investing. So I'm in the solar space, and I'm very interested in seeing how energy can be used to transform Africa, but something really worrying is happening. So a company called B-Box that is really a champion in the clean energy space, and they supply small solar systems to customers in Africa. They've now partnered with EDF Energy to deploy microgrids that part of the components will be using diesel. So they started off as a clean energy company, and now they're moving towards using diesel. How do we ensure that these contradictions don't occur as investors?
So, I'm very Machiavellian when it comes to money and sustainable impact. Let's just put the two together. So diesel is obviously a horror show, but it can be 2 steps forwards, 1 step back. And sometimes you have to take this really horrible, pragmatic view to solutions to get them to scale and get them to size. So I wasn't aware that was the development. They've done a lot of pretty bloody good work. I think one of the challenges in Africa is it's now attracting really serious big money. So Generation and Lightsource BP, as they're now called, which I get hold of Nick Boyle. it's such a massive opportunity, and there is a lot of purely commercially oriented money going in to the sector that don't necessarily have the rest. So I can't solve that particular problem. I would like it not to poison our view on the opportunity for investing in solar in Africa. It's so liberating. It's really balancing out social equality in a big way. That isn't an answer to your question, but I've certainly done investments and grown businesses where I've had to do some pretty nasty things short term because of the longer picture. So I hope they stick to what they're there to do, and that this is a meander. You know the expression, if you want to sail due north but the wind's blowing west, go west and then tack around at the last minute. Let's hope it's that.
Thank you very much. And I just wanted to finish by giving you a list of resources given by our panelists. So you have a few websites, you have the websites from the panelists, there's a podcast, and there's a few books, and I'm happy to send that over to you via Eventbrite. Make sure you check all the platforms, register on Vestpod, and I wanted to give a big thank you, big round of applause for our 3 amazing panelists. Thank you.